Hey there, it's Mitch Goldberg. Hello there. Welcome to my live stream, Be the Boss of Your Money. We talk about personal finance, investing, borrowing, spending, everything to help make you the best version of your financial self. Hey, I like the way that sounds. Welcome. It's my live stream. I usually do this at 4:30, but we run a little bit late sometimes, just depends on the day. But anyway, you know the drill. If you have any questions about what we're talking about today, or just finance, investing in general, business, stock market, you go right ahead. Hit me up in the comments. I love hearing from you. It's the best part of doing this. And if you don't mind, give it a thumbs up while you're watching us, a heart, an applause, a wow, whatever reaction you have available to you um, in whatever platform you're watching from. So go ahead, don't be shy. I think it's great when you do that, and then I get to, talk to you like we're having a conversation. And I would much rather have a conversation with dialogue with you than kind of just, you know, lecture you know, about the stock market and here's what happened, here's what's going on, here's why. I mean, we're going to do that, but when we're having a conversation, I'd rather have a dialogue than an epilogue. Does that make sense? That is always better. Serene, I see you. The cantor is in the house. Thank you so much for joining me. I really appreciate it. And also, you're welcome to ask me questions about live streaming and how I do this. And hold on, shift the camera. Just goes to show you that the one day I want to show off my cameras, I didn't turn them all on. I have a 3 camera setup, but I'll just turn one on. All right. Okay. So all the cameras are on. So this way I could go over here. Hey, how are you? It's Mitch. And I could do that. And I could do one over here. That memory card will go in a second. There you go. Okay. So, and I go back over here. So it's really cool. Let's say you have 3 people doing something and you want to go from one person to the next. And then you go to that person. Hey, hey. And then to this person. Yo, yo, up over here. That's fun to do that. All right, but all right, enough with the technology. So we're going to talk about a couple of things, but essentially, we've had an up stock market. The S&P 500 has gone up for 4 weeks in a row. It looked a little weak this morning. I mean, it was a topic of discussion on the major financial news networks. Not a big deal. Everything wound up going up today. It was just a decent day today. And we're off to a good start. So the question is, does this continue? Does the stock market keep going up? You know, we were all worried about a recession and the economy was going to do terrible. Therefore, the stock market was going to go down. That's not at all what we've been saying, by the way. What we've been talking about has consistently been uh, markets down enough by the time we really acknowledge 2 negative quarters of GDP, which would be the technical definition of a recession, by the time that happens, we'll already start going back up in the stock market. That's exactly what's happening. And I do realize that there's more than one way to define a recession, but that's the one we've been using, 2 quarters of negative GDP, which we just had. And here, okay, maybe you should help us out for live streaming services. Well, I think that would be really cool, and we could definitely talk about that. And I know I can help you out. That would be a lot of fun. We should do that. Make it a lot better than just putting the old smartphones on the stand and taping them up onto that mobile stand and then trying to make it work. But we could talk about that. I'd love to help. Okay. No, in fact, I'd love to do it. It would be fun. All right. So anyway, we're going to talk about this. We're going to roll the quick introduction. I have a couple quick things to say about Social Security. Um, it looks like there are a couple of House members who are talking about doing something to fix Social Security. We're all worried about the solvency of this program, and there's they call Social Security the third rail of politics, the electrified rail that if you touch it, you get electrocuted, and we don't want that to happen. It takes a lot of courage to talk about Social Security as a politician because, on the one hand, either you want to give more away, which you have to somehow fund that, which means tax raises, or you give less away, which doesn't even mean a tax cut. It means that we just spend less money. And this country's, we have a pretty big debt burden as it is. So right now, Social Security is a self-funded uh, program. But as far as self-funded goes, part of it is about to run out, and we might be stuck in the position in the next, let's say, 5 to 10 years of seeing a 20% cut in everybody's Social Security benefit. We certainly don't want to see that. So we have a gap to bridge. So, there's some proposals out on that. We'll talk a little bit about that. I see you, Isabel. Thank you for that very nice comment on Facebook, by the way. That was a beautiful thing to see. And I hope I'm coming in nice and clear to you guys. And LOL, we're moving into the modern era. But seriously, what does a middle-aged person with no retirement plan even begin to have a plan? Okay, so we're going to go back to that. Let me just roll the intro because that's like the exact kind of question that I want to hear in the show and talk about. So here comes the intro. Don't go away. It's just like a 15-second intro with my disclaimers. And we're going to have a good show. Here it is. All right, welcome to my live stream. I'm Mitch. We're just getting started. We already have a question out there. It's actually a significant question, and I think it's one of the best questions you could ever see on my live stream. So let's spend some time talking about this. Okay, first of all, LOL, question. Let me read it to you in case you're just listening and not watching the show. Some people do just listen to this. We are moving into the modern era, but seriously, okay, haha, we're talking about live streaming, but what does a middle-aged person with no retirement plan even begin to have a plan? What do you do when you haven't started yet? All right. Well, I know it sounds kind of obvious, and I'm not trying to be a wise ass by saying this, but the first thing to do is start, but start small. And the second thing to realize is that it's tough medicine, but not everybody can afford to have a luxurious retirement. And it's very scary because if you think anyone who's watching this, like, if you think that you are alone in not having done anything for your retirement in your middle age, you're not the only one. There's so many people in this position. So the first thing to do is to create an emergency fund. And that has to do with your own financial security. And what's an emergency fund? It's just cash in the bank, not meant for investing. You don't have to worry about finding the highest yielding, 3-month CD for it. We just want some cash in the bank. So if you need a quick, an emergency, a 15, 20, $30,000 bill, or if you get laid off and you need to dip into your savings for a few months while you find a new job, that's what the emergency fund is for. So that's the first thing someone who has not done any kind of financial planning, investment planning, retirement planning, that's the first thing you do. You get an emergency fund. Okay. The second thing you do is you have to make sure you're insured, meaning you have to have health insurance. Also, and there are plenty of programs for low income earners to get health insurance. So that is super important. And the next thing you need to do after that is see if you are financially responsible for anybody. Now, if you're middle aged, presumably, let's say your kids are past college age, you're really no longer responsible for raising your children. But if your kids are, let's say, 10, 12, 13 years old, you need some life insurance money to make sure that there is some money, some level of funds to help them get through the next 5 or 8 or 10 years of their life. It doesn't have to be money to pay for college, but just enough money so they have a roof over their head, or when somebody takes in your child, that it's not a total, complete financial burden on them, that there is money aside for the new legal custodian, legal guardian to use to help raise them for their clothing and toys and sports and whatever other things they're in. So those are the first things. And if you don't need life insurance, you're not responsible for anybody. Um, Fine, then you could skip it. If you're in a relationship with somebody, in a meaningful relationship, and you start to take on financial obligations together, like let's say you get a more expensive home, but it's okay because two people are chipping in for the rent, for example, there may be a need for some life insurance there, but it doesn't have to be a lot. Like, there you don't have to buy millions of dollars. You just That's something to look into. And then the next thing to do, okay, is to start saving money for planned expenses. This is in addition to an emergency fund. An emergency fund is not for a planned expense. That's why it's called an emergency fund. Next thing you do is you start to save some money for planned expenses. The car needs new tires, uh, rain gutters need to be fixed. These are coming, so they shouldn't be a surprise. And then you have to start setting aside money to start to pay for plan/expected expenses. And then after that, you could start investing. And then where do you start to invest? Well, you don't have to invest in a retirement plan. And if you haven't started investing yet, and you're just brand new to the planning process and you're middle age, there's a really good chance that you are already in a pretty low tax bracket. So investing in a retirement plan might be okay, but it might not be that advantageous to you. Where you invest in a retirement plan, we get a tax deduction for the money you invest, like an IRA or a 401k plan. So in that case, you could either go into a Roth IRA, which you don't get a tax deduction on the money you put into it. So let's say you make $50,000 a year, you put $3,000 into an IRA, a self-directed IRA. Instead of saying your income is 50,000, now you get to say your income is 47,000. So that $3,000 difference, you're not paying taxes on that $3,000. So you get it. That's why it's called a tax deduction. Okay. If you're making 50,000 a year and you put 3,000 into a Roth IRA, you don't get any tax deduction, but at least your money is growing tax free. And when you take the money out after the age of 59 and a half, or if you had the money in for at least 5 years, you take the money out tax free, penalty free as well in those cases. So there's a little bit more to it, but those are two ways to go. Or you could just open up a regular brokerage account. And what do you do how do you invest in it? You might just start by saying, well, can I handle $100 or $200 a month? And if it works and you get used to it, maybe you can up that to 150, 200, 300, 400 and keep going. Start small and don't think that it's so small that I'm never going to make any progress. It's never going to work. It's so minuscule. Why even bother? Don't think like that, because it's just the start. Like it's like saying, well, if I'm going to go to the gym and I can't bench press a lot of weight and I don't have a lot of endurance and I can't do the cross training class, then why even bother if it's not going to do anything? Because it's cumulative. Over a few weeks, a few months, you're going to get stronger. You're going to have more endurance. You're going to be able to bench press more. You'll be able to lift more weight, or be more effective in a cross training workout. It's just a start. $50, $100, $200 a month, whatever. It's just a start. And once you get used to it, you see how it works, you start to build up more. And you might say, well, I'm never going to make any more money. Well, at least then you're doing something. And that feel-good thing in your brain is going to kick in, and you will have at least you'll feel like you took some control over your financial situation. Isn't that a good thing? So there's no downside to doing the things I told you. Now, there is one thing in there. Okay. If you have a lot of debt, and if you have debt and you're just not even making enough money to pay it off, then you're thinking, how do I save money for an emergency fund? Well, here's the deal. If it's a question of paying off the debt or building up an emergency fund, I would rather make the minimums on the debt and save and make the emergency fund first. Okay. Now, I know there's others like Dave Ramsey, for example, who says as soon as you have your first $1,000 cash, start paying down your debt. I don't think $1,000 cash is really enough to say you have an emergency fund. I think you've got to keep going. And then eventually you'll start tackling the debt. And we could talk about tackling debt in another episode or one-on-one. And in some cases, it might pay to work with a specialist who can lower the debt, or other financial means, uh, including bankruptcy, personal bankruptcy. But that's a story for another day. But if you just can't get out from under, you have to do what you have to do. And when you finally take control of your financial situation, you will say, "I wish I'd done this sooner." You just didn't know how to start. So emergency fund, then fund for planned slash expected expenses. Look into potentially life insurance and make sure you have health insurance. And then you can start investing for the longer term. What I don't want you to do is just start investing right now and not have an emergency fund. And then all of a sudden you have an emergency need for cash and you have to sell the investments that you just invested into. And if they're lower, let's say you finally put away $20,000 or $30,000 into stocks, bad market hits, your 30,000 is worth 20,000. Now you just booked a loss and you don't even have that extra $10,000 that you could have used that you may have needed. So that's why we always say when you invest money in the market, it's got to be long term because it could go up and down for a gazillion reasons. And often when the market goes down, we don't even have a good reason until well after the fact. Okay. A few more people joined us. Jerry is out there. My friend Jerry. Jerry, you are the best. Okay. So let's get back to Serene's uh, question here. Okay. So I always keep around 10,000 in my bank account, but it's emergency money, not funds to support children. I'm not responsible for anyone. The funds I save are for planned expenses, but after that, I'm hesitant to let go of my minimal funds because I can't take the risk. That's right. You can't take the risk because you know that if you fall below a certain amount and you have an emergency, what are you going to do? Now, you may have lots of friends to hit up for borrowed funds and family, but you don't want to do that. You're an independent person. I get you. So that makes sense. I mean, that makes perfect sense that you keep a minimal balance for emergency funds. You might even want to say, take that emergency fund and put it into a separate account. So to have more mental separation when you see the balance, if you so choose. I do things like that with my own money. I like to keep different accounts for different purposes, and it does help me uh, think better, plan better, and ultimately, I feel like my choices, my decisions are better. My judgment is just better that way. But that's what works for me. It might not work for you, but that's why they call it personal finance because it's a personal decision, and two people could see the same things and disagree on it because they have their own personal feelings, their own personal biases, and their own personal way of doing things that work best for them. I so greatly appreciate you asking these questions, and I think they are some of the best questions anyone has asked on the show. Now, just so you know, when I say index funds, I have to say you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. I was talking to Jerry the other day, and he just came out and said, "Hey, Mitch, you can't invest directly into an index fund. You can only invest in a security that tracks or mimics an index." I was like, "Thank you very much for listening. I really appreciate that." But just the context is really funny. Just it kind of came out of nowhere. I think I just have a new idea for my next street sign, just to hold that up and just say that in a sign. Okay, so let's take it to the tape. Prop myself up here. Let me get rid of the social media banners. Okay, let's uh, let's do. I want to see the stocks first. Stock market. Let me make this bigger. Let me make this bigger so you can see it on your little smartphone that I know you guys are watching from. All right, so the Dow up 150 points, not a bad day. I like days when the market's up a little bit or down a little bit. I don't like days when the market's up a lot because I don't like the next day or two when the market's down a lot. I like for the market to build slow, steady, durable gains that it can hang on to as opposed to a spike up and a spike down. That's my personal preference. Nasdaq up 0.6%, S&P up 17 points, 0.04. The S&P could there's talk now that the S&P is going to be hitting a new high this year. And just to put it in perspective, we are not far from the end of the year. I'm already seeing Halloween decorations at stores. Very soon you're going to start to see Thanksgiving and Christmas decorations, just to give you an idea of how quickly the year is running out. Yields are lower on the 10-year bond. Uh, Oil is down 4. This is big. Oil down $4.05 down to 88, which, by the way, energy stocks are like the worst performing stocks of the day. And the VIX under 20, we talk about all the time. So an article that someone said, well, if the VIX is under 20, it's time to sell stocks. I actually disagree. I think when the VIX is under 20, like it is now at 19.95, that's actually a very bullish sign. One of the things we've been talking about are this market got away from people. So many investors either went into cash and or sold growth stocks to buy value stocks. And now the growth stocks are ripping higher. Investors are caught off sides, and now they're throwing money at these stocks again and getting back into the market. And now they're missing performance, and they're performance chasing. It's a powerful thing, and I think that could actually that could be powerful enough to take us through the end of the year. A couple more people. Jerry says, "LOL, yes," about the index fund thing. Okay, I'm hoping you can direct me towards how I cannot die penniless. Yeah, there's a couple ways to do that without having to just say, premature death. Okay, are we getting into like too deep here? Yeah, there are ways to go about it. They might not be the best ways for you, but we have to talk about that. Okay, and then slow and steady wins the race. You are correct, Jerry, and you are living proof. Okay. Anyway, so let's take a look at the bond market. Bonds yields are pretty much down across the board. The 10-year down to 2.788. When you see yields like this come down, there's a few things out here. Okay, what are you saying sorry for? It's quite all right. It's all good, sister. So when you see bond yields coming down, it's telling you that inflation, if inflation was the worry in the investment community that it is in the consumer category, like I'm talking us consumers, we're worried about inflation, paying sky high prices for food. You go to the supermarket, you spend, $300 and you don't even feel like you got that much stuff, right? I have 3 kids, so I spend a lot of money on groceries. But when consumers are more worried about inflation, I think, than the stock market is, than the bond market is. The bond market is telling you, with yields the way they are, that inflation is coming down. Because why are yields, on bonds still pretty low? So someone's got to be right and someone's got to be wrong. And I think the jury is still out, but my own feeling is that inflation has peaked. Inflation is coming down. Not all of it. The Fed has more work to do. The Federal Reserve will keep raising rates for a good while. But I don't think that's people think that's so bad for the stock market. Oh, the Fed's raising rates. They're still in rate rising mode. They could raise 0.75% next month in September. I think it's actually perceived by the stock market and the bond market that it's a good thing the Fed's raising rates, because it appears, at least for investors, that the Federal Reserve has taken control of the situation, that the Federal Reserve is now watching out for inflation. This is bullish that you have a vigilant Federal Reserve that's watching out for inflation. And that's why, I hear pundits on TV and elsewhere saying this is terrible. The Fed could still raise rates. We're not out of the woods yet. We spoke about that last week. I hate when people say we're not out of the woods yet. We're never out of the woods yet. There's always something to worry about. But a firm Federal Reserve, a Fed that is actively vigilant against inflation, is perceived as a good thing by the stock market, not a bad thing. It's one of the reasons why stocks are going up, in spite of these useless warnings that the Fed tightening is going to hurt the stock market. Okay? We want the Fed in control. It appeared a few months ago that the Fed lost control of inflation, lost control of the bond market, and lost the faith of investors. It's regaining that, and that is very bullish for financial assets and very bullish for decision makers, for businesses. Okay. Um, let's go here because I'm not the usual constituents. Oh, come on, we're happy to have you here. Okay, we're happy to have you here, and you're my constituent, like I'm your congregant. How about that? Okay, I like the way that sounds. Um, Constituents are okay, yeah, all good. So, a couple of other things to look at. Um, Goldman says buybacks could be pulled forward this year as companies look to dodge a new tax. They write it, they talk about how to play it. So part of the bill that's going to be signed by Biden, the Inflation Act or whatever it's, I forget the exact name of it. I've been reading up about this a lot. I know a lot of details about it. Part of it is to raise money and tax corporations 1% on what they spend on buybacks. I don't think that's that much of a big deal. So if a company wants to do a $20 billion buyback and they pay 1% of it, I don't think that's going to deter them one way or another. But what Goldman Sachs is saying, companies might want to pull forward buybacks now, but that would actually be very bullish for the stock market. Okay, because when companies buy back their own shares, they're taking money out of the stock. They're taking shares out of the stock market, which is bullish for stocks. And that means there's fewer stocks. So with fewer stocks and the same amount of investors buying the same amount of shares, you create a supply demand imbalance, which is bullish for the for the for the stock market. Okay, you're making me smile. Ignore my ineffable attempts at a comment. Siri is evil. Siri is evil, and just to show you how evil Siri is, Siri, and I one night I actually called her by the wrong name. I called her Alexa, and no worries. I called Siri Alexa, and she changed the password of my phone. She got really mean for a while. I had to really cajole her to let me go back into my phone. Is that too cheesy and corny? Yeah, I thought so. Okay. And then what else do we have? Michael. Oh, this is kind of clever. Okay, Michael Burry of The Big Short, famous investor. He sold his stock holdings and bought one stock because of the IRS getting like $80 billion in funding to hire a massive amount of new agents. He only has one stock, and that stock, it's like a comedy, okay? Geo. It jumped 8% Monday. Okay, Geo. So what's the song? Geo Group. He bought Geo Group. All right, let me pop myself in here. All right. So Michael Burry, this famous investor, bought Geo Group. Geo Group is a owner and operator of private prisons. Okay. So owner operator of prisons. So that is what the Geo Group is. So it's kind of almost comical that he sold all of his stocks, but because of IRS enforcement, he expects more people going to jail. Is that his call? That we're going to see a lot of people, a lot of tax cheats get caught? It's a strange bet, but when you think about it, it almost maybe makes sense. It's almost like it's too easy, right? Sometimes it's so sensible, it's too easy, and that's about it. And yes, Siri, she's a jealous witch. She is. Okay, so I think that's about it. I'm going to end the live stream here. We're just running up to a half an hour. Thank you so much for joining me. I love doing this show. I love doing the show. I love sharing with you knowledge and information and how I've overcome financial challenges, and especially how my clients have overcome financial challenges. Some of them are very, very successful people, and it's really interesting to hear about challenges that they've been able to overcome and share those lessons with you to hopefully make you to help you get further along your financial journey. All right. So I'm going to end this now, and I will speak to you soon. If you think of anything else you want to ask me, hit me up in the comments, and I'll see them later. Thank you very much.